we are going to talk about ESG ratings and what's coming up for next year in terms of trends, in terms of standards. And for that, we have brilliant speakers. They are all experts in ESG ratings across Europe. So let me introduce them. I'll start with Julia Haake. Julia is the head of ESG rating agency EthiFinance, based in Paris. She's been, well, you have been involved in ESG rating for the past 15 years in a long career in sustainability. So, but you also chairing the association EASRA. And Julia, let me ask you first, what can you say a few words to introduce the association, please?
Thank you so much, Emmanuel, and welcome everybody. I have the impression of repeating myself, and I really do hope that nobody heard us before. So yeah, just a few words on EASRA, which is the European representation or representative body. It's an association of ESG rating agencies and ESG data providers, not limited to the European Union, but broader, also including obviously Switzerland, the UK. We were founded 2 years ago, almost 2 years ago now, and we've gone up to 10 members. So very, very happy to have members from various countries, the UK, the Netherlands, Switzerland, France, and who am I forgetting? Various entities have, or various of our members also have offices in other places, such as Germany and Spain and Italy, and so on. So yes, we're the representative body, if you want. So we speak out on our website, on our LinkedIn page, on matters such as regulation, but also other topics around ESG ratings. And we obviously talk a lot to regulators as well, to media, and also to a broader public. So yeah, once again, thanks a lot, Emmanuel, who's also one of the dinosaurs in ESG ratings in Europe. So we're delighted to have you not only as a member in a personal capacity of EASRA, but also as the moderator today. So handing back to you.
Okay, thank you, Julia, and it's great to have our members around this afternoon to talk about the coming year. So let me introduce Diana from Maasdijk, based in Amsterdam. You are the CEO of Equileap. Equileap is a rating agency specializing in social research, and you measure companies' performance on human capital. So welcome, and we'll hear from you in a minute. I'll move on to Sylvain Forté, who's the co-founder and CEO of SESAMm, probably the leader, I'm going to say, in ESG controversies management, and he set that up already 10 years ago. Welcome to Sylvain. And we have Saurabh Shrivastava, who is the head of sustainability of data and ratings at Inrate. Inrate is based in Zurich, and Saurabh is speaking to us this afternoon from Mumbai. So it's an incredible diversity of locations this afternoon. So we're going to go through 4 topics over the next 40 minutes. We're going to try to catch up a bit the last time. 4 topics, and we start obviously with all the positive trends, whatever we hear say about ESG rating. So let me start with you, Sylvain. You know, what are the positive factors that are driving today's growth in terms of ESG linked investments, notably in private assets? How do you think it's going to evolve this year and beyond, please?
Yeah, thanks a lot, Emmanuel. And I think that's a good thing to do right now. Is I think everyone in sustainability is feeling kind of attacked, especially over the past few weeks. So let's relax a bit. We're going to share some good news. Things are also going well. And of course, we can't discard the fact that there's been a lot of ESG, anti-ESG backlash. There's been some outflows, etc. But let's consider some of the positive topics, and there are specific asset classes and specific topics that are going in the right direction. First one is actually private assets. So there have been quite a few studies in early 25 and late 24 that shows that impact-related assets, impact funds have been growing at their fastest in 2024, which is a good sign. I saw from the European Impact Investing Consortium that they grew by 20%, reached 1.9 100 billion in assets compared to just 80 billion a few years ago. So impact investing, ESG in private assets, going well. So that's a good thing. It's the same for sustainability-linked loans. Actually, EthiFinance had published a study where anecdotally it was shared, for example, that now 50% of transactions in 2023-2024 included ESG-linked criteria. So sustainability loans going in the right direction as well. And finally, just one thing, US-based, because US is a big topic right now, performance of ESG-related funds have returned 4.5% on average last year, compared to 3.8% for the S&P and 4.1% on Russell 1000. So ESG is actually performing well in 2024. So yeah, just hopefully some good news for everyone to be in a good mood to start the webinar. I'm sure there's going to be some other stuff coming as well.
Okay, well, thanks, Sylvain. Just to add another figure, and if anyone is interested in looking at the sustainability signals survey by Morgan Stanley that shows that 80% of the 900 asset owners and asset managers interviewed, 80% of them expect to see increases in their sustainable assets under management in the coming years. So is there anything, any other better news as well from your side, Julia, be it on the ESG ratings, or any other positive trends?
Yeah, well, it's a tricky question. I've been like rolling it around in my head for the last couple of days to decide what I was gonna say today, because I mean, obviously the market in general, like especially the investor market, but the market in general in Europe has been like a bit shaky over the last months and maybe even a couple of years. So we've seen a lot of, and I think that many ESG rating providers have seen those trends that, you know, on the investor side, a lot of you know, kind of cost cutting, or also merger and acquisitions and so on, like, and then post M&A reducing various contracts into less contracts with data providers. And it's not only limited to ESG, obviously, but really, you know, that's a pretty clear trend. And then obviously also on the company side, I mean, EthiFinance also does solicited ratings. So the last year or two was really what we've been hearing from companies, that, okay, we're super interested in solicited ratings, but we're very, very much occupied right now or busy right now with CSRD. So there was a lot of, you know, the market, and I think everybody's on the same page here. The market for ESG ratings and data has seen a bit slow down. I mean, after a very strong growth period, the growth rates have simply, you know, slowed down over the last couple of years. So that's just a fact and a trend. And then, you know, we had pretty, and we still have pretty, you know, positive outlooks for 2025, but obviously for the last couple of weeks or so, it's just a little bit chaotic, if you want, and especially, well, what's going to also impact our field is, we'll come back to that later, is like the regulatory slowdown post Draghi report, especially. So and omnibus and all, what have you, discussions that are going on right now. So but still, I mean, let me phrase it this way. Even, you know, in spite of the slowdown, or the, let's say, the backlash and so on, and the regulatory threats to slow or to deconstruct a little bit the current regulations. We do hear a lot of positive voices, right? Responsible investment is not going away. CSR is not going away, right? Even if, you know, even if people are maybe talking a bit less in public, the policies internal inside companies, inside the investment firms are not going away. And even, I mean, we've even heard some, you know, outspoken voices saying that, well, we do not want CSRD to go away. It's important, right, to give us guidelines and to be able to, you know, follow up on all of these crucial topics. And obviously, I mean, last but not least, and I never know if it's good news or not, but obviously climate change, biodiversity loss, these are topics that are not going away. And if we see the climate chaos that is already starting to roll out, well, we better continue on, you know, fighting against those negative trends. So, and obviously, yeah, ESG rating providers and scores and data, we're we're the main ingredient for all of these decision makers that they need in order to follow up on their CSR strategy and responsible investment strategy. So yeah, so all in all, I mean, I'm those of you who know me, I'm a very positive person, but I'm also very, you know, fundamentally positive in my outlook for 2025.
Okay, great. I fully support your enthusiasm. I was hearing again last week about the importance of CSR as a means of attracting and retaining talents. I don't think ESG or CSR will go away at all. It might be plateauing, but we can see the outlook is absolutely positive. We won't go away with only the environmental dimension, which is obvious. Those issues are facing us. We still need, you know, decision makers in investment need to be enlightened. They need, you know, data and ratings on those dimensions. Is it the same, Diana? May I ask you now? It's always obvious on the environmental side of shoes for ESG rating, and it's how important it is. But what about on the, you know, on the social, on the human capital? Is this, you know, can you see that this is growing as well, taking that dimension into account when assessing a company?
Yes, sure. I mean, I share what other panelists have said. There's definitely good news to be shared. One of the great news to be shared when we look at social data is that, for example, when I set up Equileap 9 years ago and I said I was going to rate companies on human capital, focusing on gender equality, everybody told me, you're not going to find the data. There's no data. We started doing that. We started the methodology and we started rating companies. Anyways, what we've seen in the last 9 years is an incredible increase in social data transparency. So the transparency is there. It's happening mostly because of regulation at the national level. So what we're seeing is that companies, governments from Spain, UK, Japan, for example, I'll take the Japanese example, they're forcing transparency from the corporates. They're forcing them to say, for example, what's the gender balance at all levels of their companies. They're forcing them to publish the gender pay gap. At this moment, 92% of all Japanese companies, publicly listed companies, are publishing their pay gap, their gender pay gap. Globally, one in two companies are publishing their gender pay gap. This was unheard of. So we are seeing that the transparency is increasing and we can use it. Now, the bad news is that transparency doesn't mean impact. Even though we have 44% of all the global publicly listed companies publishing their gender pay gap, only 1% of these companies have closed their gender pay gap. So I do think there's something well to be said about it, the influence of transparency and regulation, but there's also an interesting case of investors wanting more of this data and wanting to invest with it. And here again, a Japanese example, just to show one more, is that we have built an index powered on our company ratings, our gender equality company ratings, that has been outperforming its benchmark every year by 2.5%. And the Japanese pension fund is investing in it. So that's the biggest investor in the world. So here again, I say, if they're investing in it, then there is some hope that more and more investors will see. I can talk about all the bad things, but you just asked me about the good, so I'll stop there.
So social factors are increasing and the information is getting there. It's not perfect yet, but the good news is yes, and investment decision makers want that information. So,
and if I may, one more thing, what I'm seeing is that many of the, let's say, holistic ESG ratings are giving more weight today to social factors than they were a few years ago. So the social component of ESG is being weighted heavier.
Excellent. Okay. Okay, let me turn now to Saurabh, please. Would you be so enthusiastic as well about the biodiversity aspect of it? Because we know it's been there, we've been talking about it, but its integration into ratings is not that obvious. Would you say the CSRD regulation or the coming Montreal, adoption, is it going the right direction? Is biodiversity getting more obvious to responsible investors?
I would say certainly, Emmanuel. Thanks for that question. I think it's a very topical question. Biodiversity is a very, I would still say, a hot topic. And there are, I would say, 3 reasons for my optimism around biodiversity this year. The first one is just pure awareness. So, if I were to talk to a client or a prospect, say a year and a half ago or 2 years ago, I would probably hear that, I'm going to work on climate and I'm going to pick up biodiversity when I come to it. But the conversation is very different now. People look at biodiversity as an equally more important topic compared to climate. When you look at the agendas of CXOs or asset managers or asset owners, biodiversity is right up there. Even in Inrate, the quantity and quality of conversations that we are having with our clients and prospects on biodiversity is so much more higher than compared to maybe the past 2 years combined. So all of that gives me a lot of optimism. And I think one of the biggest reasons for that awareness is, of course, regulation. I do feel that the whole regulatory infrastructure or the whole regulatory ecosystem for biodiversity is coming up very well. You've got this biodiversity framework very nicely on top with its 20+ targets. I think it's set up some very strong ambition for biodiversity, be it conserving and restoring 30% of our land and sea and water, or driving very strongly the nature positive business models. There's a lot of, I think, ambition in those in the biodiversity framework. And what it has done then is to give rise to some very impactful market-based and science-based initiatives. I'm talking about initiatives such as the TNFT, the Task Force for Nature-Related Financial Disclosures, or the Science-Based Target Network. And I call them impactful because they in turn inform global disclosure standards. Think of CSRD or ESRS E4 on biodiversity, or the GRI, and there is a lot of interoperability between these standards. So the impact is so much more wider. Even for the investors, there is SFDR PAI 7, which is focused on biodiversity. So what all of this has done is it has prompted companies and corporates to publish more and provide more data. So that's the fact that we have more data is the third reason for my optimism, because it's not just more data, it also increases many times our ability to identify biodiversity related risks, opportunities, dependencies, and also mitigation pathways. So it sort of elevates the whole discussion to a different level. As a ESG or impact focused ESG rating provider, we look at biodiversity from 4 lenses, and I think we've started to get more and more data on each of those, or at least most of those. So we look at the life cycle impact assessment of each of the business activity and how each of them impact the key biodiversity loss drivers, which is sort of an indication of, if you will, the exposure of a company for its potential impact on biodiversity. We then also look at the management preparedness of a company. So you're looking at a lot of policies, practices, frameworks, metrics, and targets and programs. And here, we get a lot of information on a company level, but I think what's missing still is the supply chain, because the biodiversity supply chains are long and complex, and therefore, that's an area I would say is still to be worked at, and I'm optimistic that if not in 2025, we'll start getting more data in the next coming 2 years. The third lens is, of course, controversy, and with the increased awareness in technology, we've started to get more controversies and events related to things like habitat destruction or species endangerment. And the fourth one is very important, which is the location or asset level data. Now, biodiversity being such a regional topic, unlike climate, because when you emit somewhere, it doesn't matter where you emit, the climate impact is global. But the biodiversity impact is very regional. So you need, like, as a ESG rating provider, I would love to have more information on, a company's location of their offices, of their plants, of their factories. How big are they? What's their resource use? How much water do they use, or how much land do they use? This is the sort of information we are still, lacking, but it's coming in, and I think this is an area that will see the maximum advancement in 2025 and 26. So, net, I would say we have a lot of data to already get us started in terms of integrating biodiversity in our rating. It's only going to get better. So I have a very optimistic and positive outlook on this.
Okay. Thank you, Saurabh. Well, I'm impressed because everybody thinks we are being maybe too over optimistic. Just reading one of the questions of our attendees is that, yes, it sounds optimistic, but you are also you know exactly what's happening, and let's talk about the political side of it. The fact is there is some ESG backlash. There is a lot of people standing up against European regulation. So we have to ask you. I mean, I'll start with you, Julia, and then I'll leave Sylvain and Diana also chip in. So please, Julia, how does it impact really our business? Well, the ESG rating business.
Yeah, thanks, Emmanuel, and thank you, Pierre, for your question or remark. I mean, we're not in denial, okay? That's an important message to send out there. Obviously, we're as stunned, I think, as many others, especially in the sustainability and ESG space right now. And we should, we wanted to get a positive note into this webinar, right? Because we could have spent an hour on crying and complaining about everything that is going wrong right now. So, but still, there is a lot to comment, and I especially wanted to comment on what's currently going on in Europe around CSRD and CSDDD and the omnibus, the upcoming omnibus. I hope it doesn't roll over us. and process all down. But I just wanted to remind everybody, and maybe I'm preaching to already convince people, but anyway, things need to be said, obviously. I mean, CSRD especially was conceived to improve data availability, to improve the comparability of data, and also to make companies' lives easier, right? But yes, I'm among the people who think that the European Commission and EFRA have gone too far. It's too complex, especially for smaller companies. You know, the larger ones had a tough time preparing their reporting, and the smaller ones are just like overwhelmed by, or many of them at least, and it's costly. You need resources, you need consultants to help you, and so on. So it is true that some kind of simplification is necessary, and I won't go into detail, but and especially proportionality is a very important aspect to take into account. What does it mean for ESG rating providers? I mean, obviously, yes, the data availability will probably not improve as much as we would have liked it to. But then again, you know, especially we, a ESG data and rating provider, we're used to that, right? And that's actually also one of the core aspects of our business, to collect data and to make it comparable, even if it's not available. So, and everyone, every provider has their own means of providing, you know, more comprehensive and coherent data sets. So the impact on us, I think, will be, you know, less important than on other players. But there is one point that I really wanted to insist on, which is, you know, and it's not being discussed as much as it should, and we should collectively in Europe really stand up to this topic, which is double materiality. Because I don't know, I mean, you're probably all aware, but that's one of the issues that is currently being discussed. Should the double materiality analysis and aspect actually, and it's a fundamental philosophy of CSRD, is the double materiality approach and vision and philosophy. So if that goes away, then, I mean, we're really, you know, throwing the baby out with the bathwater is even not the nicest, it's not even not a good image to use, but it's going to be catastrophic for all of our approaches to sustainable investment, to corporate sustainability, to ESG ratings. And this is also, I mean, it's even in the statutes of EASRA to defend the double materiality approach. So yeah, I'm going to stop here. I could talk for hours.
Okay. And could you please, Sylvain and Jana, maybe also tell us, how do you see that shifting political impact on your work?
Yeah, happy to. And I just want to say also that I think it's also our role not to lay flat in front of this ESG backlash. We're at SESAMm, we're very active in the US particularly, and this is a fight. Like pushing for ESG products and going in that market and continuing to expand in that market is kind of part of an ongoing war that we have to fight. And I think we're part of a community that is active and that is not willing to just remain passive on that front. So it's also our role to really show this and some of the progress that is being made. And I specifically want to comment on the US actually, because it may be tougher sometimes to have that vision also from the EU territory. So there is a ton of backlash in the US, and a lot of ESG providers and ESG software are pulling out of the US market or prioritizing Europe right now. So this is absolutely true, and this is clear. One caveat I want to share is that SESAMm is in a slightly different category. As we provide controversy data, we're less perceived as a regulatory tool and a bit more as an operational tool, especially in private equity. So we play less in that say check the box regulation exercise, And so that plays in our favor. I really want to say that also in order to nuance that. But what we're seeing in the US is that on the one side, the ESG backlash makes a lot of funds, especially like in Texas, etc., actively fight against any kind of ESG terminology. Even when we reach out, etc., we can have some strong reactions. But at the same time, the Trump administration seems to be pushing forward a lot of M&A and private equity deals, which does increase the deal flow and therefore does increase a lot of the ESG diligence. Like in private asset, this is happening right now. We see an increase in our clients doing ESG due diligence, consultants, law firms, etc. So there's always a balance in these large-scale macroeconomic elements. And in the same way, like due to all of the political noise and media noise, etc., US corporates have felt for the past few months that they are not in any way exposed to ESG regulation and that CSRD doesn't matter and we're going to wait and wait and wait. And right now, the stats show that there is a massive increase in CSR profiles hiring inside US corporations because they're just struggling. Like they do still need to report on something on their EU activity. And so they are forced to actually push forward CSR hiring in the US. And so again, backlash, mediatic elements, etc., is one side. And I think we have to also act to show the other side of the coin, which is not everything is dark. It does create opportunities. And in terms of what this means, I think for us is clearly we should go with the current of more transparency. I think that's a key element in ESG ratings regulation. And that makes absolute sense so that there is no view whether that's a cultural element or a cultural war that ESG players are fighting. No, it's actually about truth and it's actually about interpreting data. So transparency is key. We need to focus more and more on operational impact of ESG. So engagement, risk, transition, these are key topics. Like transition in the US is very big right now, actually. There are a lot of topics, and you may have seen some rating agencies, for example, merging some of their ESG business with the more commodities business and transition. This is a clear sign that we're going in that direction. And finally, I would really echo what Saurabh was saying on supply chain. There is really a big international push towards more supply chain transparency and risk monitoring. And sometimes it's labeled ESG, sometimes it's not labeled ESG. The reality is that that business is handled by sustainability professionals right now. And even when the US says a lot of things about supply chain resilience and localization, etc., in a lot of cases, the tools that are being used are going to be the same as for a sustainability professional. So this is really more of a US view, and Diana, I'm very happy to have your view as well on regulatory element and political shift.
Yeah, thank you, Sylvain. It's very interesting your viewpoint from the US, as we don't have your insight. So thanks for that. Yes, Diana, please.
Yeah, sure. No, I agree that we are definitely in front of a backlash. And if for our company, for Equileap, if ESG is going through a deep winter, then diversity and equality is completely frozen. We definitely, I think at this point, what we have to do as a rating agency, and I will speak for myself. So as a rating agency and as Equileap, we need to go back to our mission as a company. As a social data and social rating company. What is our mission? What are we trying to achieve? And that comes first. And what we're trying to achieve is to close the equality gap in the workplace within social supply chains, human rights, gender equality, racial diversity. This is what we're trying to create, a more equal world for everyone. So when we look at our data and at our work, I really think that I'm very happy with the regulation asking for complete transparency of rating companies, because that is going to help us. I think many rating companies might have been afraid of being very transparent about their methodologies and their data, but actually this is our strength. And someone just said that at the panel. So our strength is to be completely transparent about the methodology. How are you coming up with these ratings? Tell the public all about it. Sell your raw data, not only your scores. Make sure that this is all available so that investors have as many tools as possible to use them. And in my case, which is the social data, the idea is that there is this double materiality on the other side. You use the social data for financial gains. And we deeply believe that a world with more social equality is a world with a better economy for everyone. And this is why we are also not afraid of backtesting our ratings, looking at how they're doing on the market, seeing out performances. So what I'm going to do the next few years for sure is push on the transparency as much as possible, and push on the fact that the social leads also to financial gains. And it leads to then, it's not only the right thing to do, but the financially smart thing to do. And that, I believe, is what the message has to be from many rating agencies too.
Thank you, Diana. Okay. We got another 10 minutes before answering your questions. So I'll move on to now. One of the core questions is about regulation again, but the regulation of ESG rating, as Diana mentioned, methodology. We know that a lot have been said about methodology of the lack of transparency of some of those agencies. What's the regulation going to do for that? And what are the main features of this regulation on ESG raters? Please, Julia, and then Saurabh, please.
Yes, apparently the regulatory backlash hasn't reached the ESG rating regulation yet. I don't know if any policymakers are among the participants here, but please don't forget us when you try to downsize regulation. Anyway, so yes, as far as we know, the regulation for ESG rating providers is coming, and it's going to enter into force or become applicable in mid-2026. So we have a bit less now than a year and a half to prepare. And just maybe to give you a very short overview of what this actually means. So there are two, I think, major aspects in this regulation, which are actually good for the whole industry and for the whole supply chain, let's say, around ESG data and ratings and scores. And I think, yeah, I know that we are all aligned within the EASRA on the fact that we really welcome the regulation, because it's supposed to really set a more level playing field for the ESG providers in Europe. So the two main aspects are, on the one hand, more transparency, because yes, as you said, Emmanuel, there was always that complaint that it was difficult to see behind the scenes and to understand what an ESG rating or an ESG score was actually about, what was taken into account, and how the different topics and pillars were weighted, and how analysts came to conclusions on when analyzing a company on their sustainability performance. So that's one aspect where we'll be asked to make our methodologies transparent in different levels towards clients and rated companies and to a broader public. But anyway, it's already, rating providers have already started making their methodologies available, because we all know it's coming, and that, yeah, it's a good thing for everybody to understand how we actually work. The second big item is conflict of interest management. So that's a very important topic within that regulatory text, and there's a lot of similarity in the text with the credit rating agency regulation. So there's really, sometimes even copy paste from the credit rating regulation. So we're going to have to put in place, for those of you who don't have it yet, because some, like EthiFinance and others, we have a credit rating business, so we have a compliance function, and we have internal rules and so on. So we're going to deploy them to our ESG rating business as well, as far as they haven't been so yet. But there are obviously others. One implication of the conflict of interest management is that there is a list of activities in the regulatory text that are considered not compatible with ESG ratings. So there is a ask for separation of business obviously against credit ratings and others like asset management, audit, consulting. So that's going to be an important thing to put in place for many of us. But we'll also, you know, when it comes to interacting with the companies that are rated, we'll have to inform the rated entities about soon to be published ESG ratings and scores. And we'll also, you know, for many of us have to adapt our IT systems, the way in which we, you know, register who has worked on which rating in which step and so on. So it's a major, it has major implications for ESG rating providers, and we've really fought pretty hard, or at least we tried at EASRA. And within our different entity member companies to implement a stronger proportionality rule, which we haven't succeeded in as far as we would have liked to. But this is, I mean, we keep talking about it, right? Because, I mean, hi, ESMA and the European Commission, if you're listening to us, we're still worried about the financial implications for the smaller players, and also especially the mid-sized players, because the smaller players are already protected under the proportionality rule. But yeah, the mid-sized players, it's another piece of cake, as you say. So it's going to, I think we've all started working and preparing for the upcoming regulation, and it's a lot of work, yes.
So thanks, Julia. Saurabh, on the Inrate side, how do you view that, and how things are evolving there?
Yeah, I think Julia did cover a lot of it, Emmanuel, but I would just like to add a couple more things. So we did talk about transparency with regards to methodology. And I think the other area that is being asked of ESG rating providers to be more transparent of is around data and data sources. So detailed explanation about sources, which of those data points are estimated versus which are reported. All of this is part of the regulation as well. And Julia did touch upon it. There's also a specific, I think it'll evolve into a specific requirement of almost having a pre-publication validation from issuers. Meaning that the data that flows into the methodologies that are already public has also to be verified by the people who actually publish that data, which makes the rating high quality. But of course, there are IT implications and requirements on the ESG rating providers to build such systems to be able to share data with issuers on almost a real-time basis. A couple of other things around governance. Of course, conflict of interest is a big area, but I think that there are other things that the governance aspect asks of ESG rating providers, particularly having oversight committees to review any changes in rating methodology or model updates, having direct supervisory roles to basically sign off on some of those changes. And then there are, of course, many rules which talk to independence and objectivity, meaning separations of sales and commercial functions with the rating analyst, very much like the credit rating world. So a lot of it, as Julia said, has been taken from credit rating as well. I would also add an important element of data quality. The regulations also really very strongly push forth the topic of data quality, problem resolution, and stakeholder interaction when it comes to any problems in data quality. So there is need, or there will be need for all of the rating providers to have very strong quality assurance frameworks. Things like automated rule-based checks, but also combining human intervention when it comes to quality, early warning systems, ways to have rigorous validation checks by from multiple sources, triangulation, etc., and also a dispute regulation process. So, in case an issuer is not happy about their rating, there needs to be a formal dispute resolution process in place. So clearly a lot to be done from an ESG rating provider's perspective.
And let me ask you and finish. That's my last question to the panelists, please. Saurabh, can you say, about data collection? What's the impact, for instance, of artificial intelligence? And then I'll move on to Sylvain to close up that question. But yeah, what's the greatest impact of AI on your data collection?
Sure, I think this is not just for Inrate, but I think a lot of ESG rating providers are looking at AI for effective data collection and curation. And this obviously has a big impact on scalability. How many issuers can be covered, so coverage expansion, also how granular can we go in terms of data collection. AI-based or ML-based data collection models from company reports, news, regulatory filings, industry sources, and so on. It also gives the ability for rating providers to collect data in multiple languages, because earlier we were very restricted by the language capabilities of our analysts, but no longer with AI. It gives us a huge advantage from a multi-language processing perspective. There are also a lot of impact from a data quality assurance perspective, because you can now use AI for identifying inconsistencies or missing data points or anomalies, things like entity matching or deduplication processes. Also cross-referencing various data sources to make sure that what you have is latest and the greatest data. And I would say there's a third one, which is growing as I speak, which is the use of AI in actually making the assessment. Now, there are a lot of limitations with this, and people are experimenting using the AI to have the AI read the guidance, but also read disclosures and marry the two to create an assessment. But there are multiple limitations still that need to be overcome. The biggest being, gaps in training data, or the inability of AI to read contextual nuances, being able to differentiate a greenwashing statement from an actual disclosure. So that's where we are at, and I think.
Okay.
Emmanuel, if I may add one last thing before you move on, because I just think that it's really important for us to say that the regulation of ESG ratings is really actually a good thing. It's a really good thing, and it's asking for three things that will help our sector. It's asking for more transparency, it's asking for good governance, and it's asking for no conflict of interest. So I don't think any of those things are really difficult for the good agencies that are providers that are having ratings, and it's going to help us to fight this backlash of people saying, what is this ESG? What is this in here? Why is one rating different than the other one? I don't understand. It's probably nothing, just put it away, it's not material. So it's really, I think, a good thing that there will be a regulation. I think it's just a matter of seeing that it is effective enough, that we're not drowning in bureaucracy, that we're able to do it and move on with our business. That's the difficult thing, and that's what we want to do together, and that's why we have this network. But actually regulating and bringing this transparency and good governance and demand for no conflict of interest is a very good thing.
Okay, thanks, Jana. Sylvain, if you want to finish on the AI, and I'm going to ask you a question which is linked to one of the questions. Do you see AI data collection, as you use it a lot? Is there something to do with a better quality? How AI, in other words, is going to impact the data collection and its quality at SESAMm, for instance?
Yeah. It's pretty transformative. Again, we have a different approach because we provide AI technologies, including to rating agencies. So we're more part of that transformation, and we're often the AI enabler. What I want to say is that ESG and sustainability is analyst heavy. So it's naturally a whole industry that will be transformed by AI, as will a lot of other industries. So what we're seeing is, like Saurabh, that AI is a way to expand the coverage without sacrificing quality. So that's honestly the goal now. It's expanding the coverage, but without having to massively expand teams of analysts. That's the primary goal that a lot of rating agencies have. And with the word of generative AI, honestly, there's a lot that can be done. AI 5 years ago is not the same as AI 3 years ago, is not the same as AI 6 months ago. And I think examples such as O1, O3 Mini, DeepSeek, etc., shows that the gap between data collection performed by a human being and data collection performed by an AI is narrowing very quickly and is, to an extent, I wouldn't say non-existent, but it's starting to be very, very small. So I think we have to be realistic also as an industry being transformed. And so I'm pretty optimistic that a lot of workflows will be further automated using AI, which primarily will increase the coverage of all rating agencies, will increase transparency also, because if at least AI can rely on a specific data source and cite it as a specific link, there is maybe less interpretation that is done, at least if you control your workflow properly. Possibility to increase the number of languages is super interesting as well. And there's also the possibility of adding features that would never have been available before. So think of, I have a document which is provided, say, by a rating agency, etc. And I can do now a generative AI summary of 3 lines on a 100-page document, and I can do it just in 1 click. That seems normal now, but just a few years ago, that wasn't possible with a high degree of quality. Or even doing some preliminary reports for due diligence in private equity in 1 click with AI is now possible. And that wasn't possible a few years ago. So I think this will massively transform the industry, primarily by increasing the coverage, number of use cases, and functionalities for clients. So I'm pretty optimistic about this.
If I can add just one quick point, Sylvain. I don't know your experience,
quick one,
but yes, a very quick one, Emmanuel. There is, I think most people, if not all, have like a human in the loop when you use AI, to make sure that the AI remains true and honest. So it's not like AI all the way, but you've got a human in the loop in critical to quality places. I just wanted to add that point.
Yep, that makes sense. And even for us doing almost exclusively AI, we still have a team of analysts checking severe controversies, because that remains important. You're absolutely right, sir.
So there is no contradiction between AI data collection and human analysis. I think it will be obviously a good thing. Right. Well, I would like to come to an end, but pick a few questions before we close, as we started a bit later. There was one question from Candice, but it's disappeared. How come ESG is impacting quite well the private assets as opposed to the listed assets?
Yeah, sorry, Emmanuel, it actually disappeared because I responded in writing to this one.
Okay, good.
Yeah.
All right, okay. Well, do you want to say a word about private assets?
Yeah, we're seeing some positive impacts, honestly. I think the fact that more impact funds specifically have been created, and the fact that maybe the exposure to backlash is a bit lower in private equity is a good sign. I don't think that's zero impact, but maybe less than large, say, ETF providers or large asset managers that handle US pensions are much more likely to be under attack by in the Trump administration. So not zero impact, but probably that's one that's going to resist to continue to do transition and engage also with portfolio companies. And I'm so sorry I have to run. I have a meeting, so
we're going to
have to go.
Just a final. Yeah, you can go and leave an answer to that question. Julia, would you say that ESG ratings, is there a matter of size as well? Is there a big advantage of being big rather than small? And do you see less or greater number of people withdrawing from the ESG rating regulation?
So yeah, I saw that question. Very interesting. I mean, there is one example, and I'm not gonna, but I'm not gonna say who I'm talking about, but most of you probably know who I'm talking about. There was one major player, or a very large player, who pulled out of the ESG business last year. Last summer. So obviously we don't know why, but yeah, there were probably many reasons, but maybe one of them was the pressure, political pressure in the US. Maybe another one could be upcoming regulation. So So that's, you can't say that there is a trend, but there is a big example out there, right? Unfortunately, we have a few number of very small players who had to pull out of the market because simply they didn't survive. And you know what I said earlier to the trend, that the market conditions are pretty difficult. So there are some small players who simply didn't survive. But you know, what we have seen of all of these trends is that it's rather the big competitors that are you know, that are gaining ground due to these, because you know, everybody needs a very large coverage, everybody needs the fancy platforms, everybody needs like a one-stop shop basic offering, and the smaller players simply don't offer that kind of one-stop shop offering at the moment. So it's rather the bigger players who were already, you know, been pretty aggressive in the market and, you know, have very high market share. So yeah, I mean, it will be interesting to follow up on how our market evolves over the next 12 to 24 months. I would say it's definitely exciting times, not only easy times, but yeah, I think we had a great discussion today. So
thank you, and let's keep us rowing in the right direction. I would like to be well, my gratitude to the panelists and for their valuable testimonials. So, and thank you for all of you to have joined us this afternoon. There'll be a follow-up in the next 12 months. Okay.
definitely.
Thank you all. Goodbye.
Bye-bye.
Bye-bye.